Welcome to EDS, and in this video we're going to take a look at how you can write your own options contracts, collect a premium upfront, and then generate consistent returns year on year. So of course the vehicle that we're going to be using, the instrument that we're going to be using is options, specifically writing options contracts. So we need to see where we are in the options cycle. So the first thing you want to do is just pull up any underlying in the S&P. It doesn't really matter what it is, and this is just so that you can see a list of expirations, and everything with a orange W is a weekly, everything else is a monthly expiration. For what we're going to be going over in this video, we want to stick with the monthly expirations. So the next monthly expiration is October 18th, which is 21 days out in time. That is too close for us. We like to be around 45 days out in time. So we are going to skip the 18th and go to November 15th, which is 49 days out in time instead. So now we know our contracts are going to have a starting duration of 49 days. We can take that information, come over to our watch list, and we can filter out all underlyings that have earnings between now and the next 49 days. And the reason for why we do this is because we don't want earnings to interrupt our trade. It will potentially mess up your deltas. It will almost definitely increase volatility. And overall, it will likely have a negative effect on your P&L. So we want to stay away from earnings, and we also want to stay away from low liquidity level underlyings. So as you can see here, we've unticked the lower liquidity level stuff, and we're only going to be seeing the 3 and 4 out of 4 star liquidity underlyings. So what we've got here is a list of things that we can trade, high liquidity, doesn't have earnings, and now all that's left to do is order everything from high IVR to low IVR. And the reason for why this is because we want to sell volatility. We want to sell when volatility is high and play the contraction back down to the mean and even lower. So we just go down the list, and one by one we just see what might fit well in our portfolio. So you want to make sure you're not too heavy in any one sector or industry. You want to make sure you're nicely diversified. So keep an eye on your portfolio and keep in mind what positions you've already got on when you are choosing new positions. I believe yesterday we did have a look at BABA. We can have a look at BIDU. I think we probably will have a look at BIDU. It's got a decent liquidity level, an IV rank of 84.4, which is very nice and high. Any IV rank over 50 is considered high. However, anything over 30 in these market conditions can also be considered high, especially for things like ETFs. So let's just go with BIDU, and we go into the trade tab. As we can see, it does have earnings on November 19th, which is just slightly outside of the November 15th expiration date. We're not going to want to actually, we're going to want to try and be out of this trade well before the 49 days. So hopefully we won't need to worry about earnings. We open up the expiration, and now we can see the options chain. This orange horizontal bar shows you where price currently is with respect to the rest of the strikes. As we can see, it's currently trading at about $104, which is right in between 100 and 105. This vertical orange bar here shows you the expected move of BIDU over the next 49 days. And now all that's left to do is to actually sell some contracts. So what contracts are we going to sell, and where are we going to sell them? Well, there's two types of contracts, calls or puts. That's it. So we're going to sell one call and we're going to sell one put. Now, where do we sell them? Well, I personally like to sell my contracts at anywhere between a 15 and 20 delta, give or take, depending on volatility, but anywhere between a 15 and 20 delta. So we go over to the call side, and we can look over here at the delta column, and we can see a 15 and 20 delta here. We're spoiled for choice. I think we'll go with the 15 delta on the call side, be a little bit more conservative. And then we go over to the put side, do the same thing again. There isn't an exact 15 delta, however, there is a 16 delta, and that is close enough. So let's have a look at the position so far. We'd be looking to sell a call contract at the 130 strike, and we'd also be looking to sell a put contract at the 90 strike. As you can see, our contracts are outside of the expected move. That's going to ensure that we have a high probability of profit. As you can see here, we've got a 75% probability of profit and an 88% chance of hitting 50% max profit over the course of the trade. We'd get $9, over $9 in daily theta decay. We'd collect $315 upfront on day one, and our broker is only going to require us to have about 2.2k in buying power. So this is actually a very nice return on capital trade for a naked position. BIDU has got a very high IV rank. Earnings is quite far away. If we plot this on the chart, so we've got strikes at 90 and 130. So we've got our strikes at 90 and then also at 130. As you can see, we are in the middle of the range. Implied volatility or IV rank has spiked, or it currently is in the process of spiking. And overall, this looks like a very nice, clean position. We've got a very wide range. IV is very nice and high, and I would actually be looking to put this position on, but we are pretty maxed out in our portfolio, so we are going to give this a miss. However, if we did have the space, this is definitely a nice position. So with that in mind, there is also something else you need to know, and that is the sizing of your position. So it doesn't matter what you do, how you trade, what you know, if your sizing is wrong, it will ultimately end poorly for you. So we have a position sizing template. It's free for everyone to use. The way it works is you enter in the size of your portfolio. Let's say if it's $15,000. Below that, you will then enter in what the current VIX level is. Let's say if it's 14.2. Everything below will then be automatically calculated for you. It will tell you how much buying power to allocate to each undefined risk position, each defined risk position, how much of your portfolio you should allocate to short premium strategies in general. And as long as you use this information to form the backbone of your portfolio, long term, you will be just fine. If you want to get yourself a copy of this spreadsheet, click the link in the description, head over to the free position sizing template, and it will take you to the spreadsheet. If you want to get involved on the positions that we're placing, and if you want to make money with us and learn with us, again, click the link in the description. Head over to EDS Premium, get yourself signed up. You'll get access to all of our portfolios, large and small, so there'll always be positions for you to copy, no matter what the size of your portfolio is. We have a full course inside, no prior knowledge is required, and we'll teach you everything you need to know. This allows you to learn and earn at the same time. It is a private community, so you can speak with myself and other like-minded individuals. There is also a 100% money-back guarantee. So if you studied our full course and followed our trades for 6 months and haven't seen results, then we will work with you for free until you do, or you can just request a full refund. So it's completely risk-free. It's £1 a month right now. The price will be increasing. Once you're in, the price is locked in for you. You don't need to worry about price increases. You are rewarded for getting in early. And with that being said, I will see you guys on the inside.